Well, thank you very much, everyone. It's fantastic to be here with you today. Couldn't be more excited, and I'm delighted that despite Lou's desire to have 150,000 people in the audience, it won't be me speaking before the 150,000 when they do get here. But I am thrilled to be here. Utah is an incredibly important part of our organization, and frankly, we're putting more and more people on the ground from a global basis in Salt Lake specifically, as well as in some of the other mountain states. So that'll be a reflection of the importance that we place on the businesses that you're all building. So with that said, I wanted to start first, if you'll indulge me for a moment. And, I know as Sam was talking about vision and brand, and of course, we at Wells Fargo feel very strongly about both our brand and our vision. So I'm going to start, if you don't mind, spending a minute on our vision. And quite simply, what that vision is that we want to help our clients succeed and meet all their financial needs. And everything at Wells Fargo, frankly, starts with that vision. Our chairman, when he gets up, he does an internal presentation. It starts with that vision. And it's important because what it says to us as an institution is that we put our clients first. And not only do we put our clients first, but it unites the businesses within Wells Fargo. As you can imagine, there are many, many different businesses within the institution. So having that common vision, that common value, I think is really important to the institution. And interestingly enough, to me at least, this was written over 20 years ago. And I think it's every bit as true today as it will be in 20 years when that other person is standing up here speaking to all of you and your successors. So as you can see, not only do we put the client first, but we also put the client in the center of everything we do. And the same holds true with international as well. And as we're talking to our clients and we're wanting to understand a little bit more about what they do, we always tell them that there are many different solutions for the challenges and the opportunities that you're facing. But where we like to start is always at the same place, and that's really understanding our clients and where they are on the global expansion life cycle, if you like. So understanding whether they're just starting out, whether they're very advanced, they've been in this business for a while, is really key to creating a tailored solution for them that will allow them to be able to leverage it and use it going forward. So there are many things, when we talk about how our clients are growing their business and how they're thinking about it that we could consider in this discussion. We could talk about things like regulatory and compliance, and certainly compliance is a headline grabber these days. We could talk about hedging foreign exchange strategies. We could talk about a decentralized model versus a centralized model. All of these things are very relevant and items and issues and strategies that folks should consider as they move along the spectrum on the international growth life cycle. But one thing that I would suggest is that probably the biggest key and perhaps some of the biggest challenges that folks need to consider is how are they going to fund that growth. So that, in fact, is going to be the area that we focus on in this conversation. So depending upon where folks are in their life cycle, there are lots of ways that we can help them. And what I want to do in this presentation is give you 3 examples of companies that are in various stages and how we've actually worked with them and some of the challenges that they were facing. Because it's a broad group, and I'm sure that many of you are at different stages yourself. So in an attempt to make sure that we're covering ground that's interesting to most, we'll do that. But before we do, I wanted to also outline for you a little bit of some of the tools that are available and that Wells Fargo uses when we work with our clients. So we have the traditional financing. We have, working capital financing. We have term lending. We've done these for clients both in US dollars as well as in local currencies. We've got trade finance solutions, and we've got structured trade solutions. And the trade finance solutions typically are more short-term oriented, more immediate working capital. The trade finance solutions or structured trade solutions can be much longer term in nature. They can help with medium-term financing, and they can be done either using public sector support, Exim, OPIC, for example, the SBA, or they could be done using shorter term solution, or sorry, private sector solutions. So things like insurance companies insuring for an AR that can then be monetized and support your expansion plans that way. So these, just wanted to lay out for you some ideas around different areas that are available to you as you're thinking of financing. But let me dive right into the examples, because I don't know about you, but that's where I learned the most from. So I want to start with a company that's very early on in its life cycle. So this is a company that I know well that had been quite successful in the domestic market, had done very well in the domestic market. And I got a phone call one day and they said, we just got an order from China. In some respects, it was the best of times and it was the worst of times for this company. And they were very concerned, obviously, about shipping their goods and making sure that they were going to get paid at the end of the day for that. So we said to them, and this won't surprise some of you in the room, we suggested that a good financing alternative for them would be an export letter of credit. And we said, go to your Chinese buyer, have them issue an export letter of credit. For those of you that are less familiar with letters of credit, what effectively that does is it allows the buyer's bank to substitute their credit risk for the buyer's credit risk. And then when you lay a confirmation over the top of it, such as we were proposing, it allows us to therefore substitute that foreign bank's risk for our risk. And it takes not only the bank risk out of it, but also the country risk with that. So they liked that idea. They went back to their buyer, and their buyer said, yeah, that's a great plan. We like that. We'll be willing to do that. But we're using a Tier 2 Chinese bank. Is that okay? Now, they didn't call it a Tier 2 Chinese bank. We called it a Tier 2 Chinese bank. But that, in fact, was the case. And we said, yeah, that's not a problem. We can certainly confirm a Tier 2 Chinese bank. And again, for those of you that are not familiar, Tier 2 is sort of the next level down from the big Chinese banks. And we said, yes, that's not a problem. We can do that. But then they added another wrinkle. And the other wrinkle was that the buyer then wanted 180-day terms along with it. And so now you've got our client saying, I don't want to wait 180 days to get paid on this. We said, never fear, we've got a solution for you. We can discount that LC. But what we want you to make sure of is when that letter of credit gets opened, we want you to make sure that the fees associated with discounting the letter of credit actually get paid to the account of the buyer. Because effectively what the buyer is doing in that point is asking you or asking our customer to finance their working capital. And so they said, okay, that makes sense. And they went back to the buyer and they were able to negotiate that. And so everyone was happy. And in truth, our client was happy for very obvious reasons, but also the buyer was happy because the buyer got term financing for their product, their working capital financing. And at the same time, they probably got a rate that was more economical for them than it would be if they were actually trying to get local currency financing themselves. So the next example I want to talk to you about is a mid-phase company on the global expansion life cycle. In the global expansion, what we see are clients that typically will, start out, they'll get their first international sale, that'll continue to go on, they'll get more and more comfortable in that milieu. They'll maybe move from letters of credit in support of their transactions to collections, perhaps to open account if they know that buyer particularly well. And then after a while, they get enough of a critical mass in their business that what they want to do is they want to start putting subsidiaries abroad. So they could be manufacturing, they could be distribution, but one way or the other, they want to expand physically into some of those local markets. Our experience has also showed us is that clients, when they do want to take that first foray into those markets, in the middle market, typically want to stay a little closer to home. So they'll look for countries where they either have a common heritage, common language, where they have, a close geographic proximity so that they can have oversight over those operations a little bit more fully. There's perhaps a similar rule of law or a common language. So Canada is an obvious, target for them as they're growing. But also, you get a lot of European countries, the UK, you may get Germany, you may get, other European countries and Mexico as well for that reason. But the case I want to talk to you about today is a client of ours that has got subsidiaries in Canada. They manufacture herbal medicines, and they were funding themselves out of the US, using their US revolver, funding their Canadian operations. And they were noticing that as the Canadian dollar was devaluing, that it was causing them great pain because it would take obviously more Canadian dollars to convert into US dollars in order to service the debt that they were carrying. And they said, what can you do? And we said, well, no one solution, right? There's many solutions, among them foreign exchange. Could use foreign exchange. But have you considered actually putting Canadian dollar debt into your Canadian dollar subsidiary? And that way, what you would do is match your expenses to the functional currency of your revenues. And you would, of course, overlay a guarantee over that. And the reason why you want to overlay the guarantee is because when you looked at this entity, the strongest creditworthiness in the entity was the U.S. parent, and so the best deal that you could cut was working with the U.S. parent. So they were able to leverage the financial strength of the U.S. parent, and they were able to put Canadian dollar denominated debt in their Canadian sub. So they said, well, we like that idea. Let's go along with that. So we actually provided them with a $15 million term loan and a $5 million Canadian revolving line of credit. Both were Canadian denominated, which we funded out of our Toronto branch, in which we actually leveraged our team in Toronto to help the Canadian subsidiary with, the process and the documentation, et cetera. So that all went swimmingly, but there were two other benefits that came out of it that the client, I think, hadn't completely appreciated. And the first was that Canada was a higher tax jurisdiction. So when you put debt in Canada and you have to deduct the interest expense to get to your net income, you have a lower net income, and therefore you pay less tax on that. And so there was actually a tax efficiency that came along with this structure. But the third point that was highly beneficial, and to be honest with you, I think folks hadn't really considered, was the fact that there is a real discipline in putting debt in the Canadian entity, right? And that the Canadian management team that was being measured on how effective their operations were suddenly thought maybe they didn't need quite that much inventory, and maybe that CapEx project could be deferred for a year. So that discipline around it really had an unexpected benefit for our client. So the last example that I want to talk to you a little bit about is the next stage. Now you've gone from a company that's got lots of subsidiaries, not just in Canada or nearby, but now they've got lots of subsidiaries around the world. They could have subsidiaries in, India or in China or in Malaysia or Hong Kong. They could have subsidiaries in Europe. And typically what we see from those clients is that they go to a hub and spoke approach. And so they have either a holding company or a treasury operation center in one of the geographies that is typically slightly more tax friendly, shall we say, so Dublin or the Netherlands or Singapore perhaps. And from those subsidiaries, they support the branches intra-region. So, if you're in Singapore and you've got a subsidiary in Hong Kong, or you have a subsidiary in mainland China, then they will use, those the support that they get from those hubs. Now, the structure that we would and have seen employed in those kinds of companies is we underwrite a global facility at the parent company level. And then we have tranches that go out to those holding companies, and they're multi-currency tranches. So the subsidiaries can then borrow in-country currencies from them. Typically, there's a guarantee that goes upstream and or a pledge of shares of the subsidiaries, usually about 66 2/3 to make it tax efficient as well. So that way you're able to, combine the group all together and also allow them to have the benefit of the cash flow downstream. The one other point that's important to speak about in that regard is that not only do those regional treasury centers operate as a financing hub, but they typically act as the collection and disbursement account for these entities in countries. So they can work with clients with their subsidiaries that are long cash, and use that cash to finance subsidiaries within their group that may be net borrowers. So that way they actually reduce the amount of debt that they need to take on themselves. But imagine the complexity of the different cross-border regulations and the different currencies and the requirements around that. So I'm very mindful of time. I probably run a bit over. I thank you for your attention. If I can leave you, though, with one thought, and if you take nothing else away, please take away this. As you move up the curve on the global expansion front, it may be self-evident, but it's very clear to me the complexity really, really increases dramatically. And so you need to find yourself a very good, trusted advisor that can help you understand and think through the nuances of these strategies, and that can also not only help you now at the stage that you're at, but that candidly can help you as you're continuing to grow your business and take that to the next level. So I really thank you very much for your time and attention today. It's been great spending time with you, and hopefully we'll have a chance to connect as we're milling about for the rest of the day. So thank you.